got one really good one on my what is called the anti-portfolio, stars I didn't invest in. I met Whatnot at pre-seed. Whatnot is a collectibles platform. I think their last valuation was something like $4 billion, and it was the largest e-commerce marketplace, or the quickest e-commerce marketplace to reach $1 billion in valuation. Happened kind of seemingly overnight, and so within 2-3 years of us meeting them, they were absolutely crushing it. But man, there were certainly some things that we probably diligenced incorrectly that we needed to have looked at a little bit different. But yeah, no, it was certainly an interesting time, and we had a lot of very long and heartfelt conversations at Brightline about where our investment thesis might have fallen short.
Today's guest is a venture capitalist at Techstars, a startup accelerator with over 21 unicorns and $116 billion in cumulative market cap across the startups it's backed. Now, Fred has also been a founder and has mentored many startups. So without further ado, Fred, welcome to the Builders and Funders Show.
Thank you. It's a pleasure to be here, Burke.
It's a pleasure having you. I want to go back to one of your earliest experiences. You mentioned you built a startup. It was called, I believe, Packfed, where you sold it at 19 years old. Tell me the story behind Packfed. What was it and how did you build it?
So Packfed wasn't actually a startup that I started when I was 19. If you want to talk about the 19-year-old one, I'm happy to. That was a kind of an interesting idea that I had come up with at the time, just meeting a lot of people. My sister and I lived in Hollywood at the time, and there's this thing called craft catering, and craft catering is all the food that's actually on set. And so there's really, really significant contracts for this. It's half catering, half, running to the grocery store and buying snacks and things like that. And I realized that it was a very decentralized kind of place, and that there wasn't really, there were kind of a handful of players, but it was pretty fragmented all in all. There were like a lot of very sizable contracts that were really just being won through relatively minor conversations and things like that. And so what I ended up doing was creating, in effect, a marketplace for those. And what it allowed was for studios, especially kind of the more middle and smaller size studios that are a lot more budget conscious and so on, to be able to reach a larger set of different craft caterers at the end of the day. So I ran that for about 18 months and was able to sell it for what felt like a lot of money at the time. I was 19 when that happened.
Interesting. So how old were you when you founded the company? Like 17, 16?
I was 18 when I first started it. Yeah. So it started, I think, October of 2008, I think, something like that.
Okay. So you're in Los Angeles. You're 18 years old. You're speaking to these studios. How did you even start talking to those studios? Were you kind of like interning and you realized this was a thing, or how did that connection come about? How did you even realize this was an issue, and how did you kind of get that connection?
It was, I think, and you can speak to this as well, given your own background, but I think that being young made life a little bit easier in terms of actually getting in front of people. And so I spent a lot of time networking. There are a lot of catering specific, or not catering, but event planning and things like that, specific events that you can go to. And I just went to every one that I possibly could. And it was a really good way to meet people and start to build those relationships. And so I'd say that's where the majority of it came from. But I have to say, over time, I think it became easier and easier just because it really is not it's not a particularly easy thing to do. Or I don't know what it's like now, but certainly at the time, it wasn't like you could go and Google, craft caterers. It wasn't particularly easy to find somebody who had that kind of expertise specifically, rather than just kind of more traditional catering. And so I think that it just worked for the market in a pretty cohesive way, especially, like I said, for people who are doing smaller music video shoots or something like that, as opposed to, these really, really widespread deals for, an A-list movie or something like that.
Mm-hmm. Well, so I guess what I was trying to get at was the inception, right? You're 18, you don't have lots of industry experience. How do you get exposure to these studios or little shoots where you kind of hear about this being a potential issue? Were you at the time, were you interested in kind of filmmaking or that end of things where you start joining some of these, sets and you're observing things, or how did that kind of what planted the seed is, I guess, what I'm trying to get out here?
Yeah, no, that's a great question. So I actually knew somebody who owned a pretty successful catering company. And I think it was just kind of this interesting point on being somewhere geographically and being exposed to the film industry. And I mean, I don't know how much time you've spent in Hollywood, but it's very, very difficult to not meet anybody who's in the industry. And so I think, in addition to having a good friend who was actually quite successful in catering, I kind of saw this and I was like pinging him and asking him, what have you ever done anything like this? What do you know about it? And yeah, just kind of learning about it from there. But I think it was just pretty organic from kind of pairing some of the friends I was making in Hollywood with somebody I had an existing relationship with.
Interesting. So before we get into like being a VC and becoming an investor, I kind of want to go over the process of building it. So now you've got this idea, you've got the seeds, there's an issue to solve. How do you build it from there? Like how does an 18-year-old figure out how to build something like this?
Sloppily. I mean, I think that it ended up working out well, but it was just such trial and error of me trying to figure things out. And I think that I really lucked out in that I was speaking with a lot of people who were very patient with me. And that at the end of the day, what mattered to them was kind of performance and me showing up and so on. But I would say that realistically, what ended up happening is that it took me forever to get something like 5 deals. And then after that, everybody's like, oh, he can actually be trusted. This is actually somebody to talk to and so on. Versus when I kind of first started, where there was just kind of this initial upfront piece. But gosh, Berg, I had to have worked for, I don't know, 3 or 4 months at least with like nothing to show for it before anything really came out. And it was just me hustling, trying to get something done.
Wow. We had, so like a lot of people, when you look at them and you hear their success stories, like we had Jeff Ralston, he was the former president of Y Combinator. You look at the guy, you're like, he sold 2 startups to Yahoo and Apple, and he's been successful. Or even you look at your career, like I exit at 19, now successful career in venture capital. He's got it all. But usually there's like these values of like moments of despair. You mentioned you're going 3, 4 months without closing any deals, but usually sometimes there's like a moment maybe that where you're like, oh my God, what have I gotten myself into? Maybe I am, maybe I should just quit this. Maybe I should go do something else. I always love to cover those moments and tell the stories behind those. Tell me about that. Like within those 3, 4 months or even after that, were there any like specific moments where you're just like that movie kind of scene where you're like up against the wall and you're like, oh man, what am I doing with my life here? And how did you deal with that? Was there like a quote you said to yourself, some that you were saying to yourself or looking at to deal with it?
Yeah, we actually ended up having a caterer pull out last minute. And this happened to us a handful of times where somebody actually did, and we were really on the hook because while we were a marketplace, we really kind of won the contract and then sold it more so than anything else. And so the studio was still looking at us like, you're going to need to figure this out. Like we're doing this in, I don't know, 2 or 3 days and whatever the case is. And so thankfully I knew a chef and was able to get that part of it together. But there's a lot of staffing involved in it in terms of just kind of taking care of things and keeping things neat and clean and so on and so forth. And I remember trying to hire a couple servers and I just had no idea where to start and whatever. And I think I put up a couple Craigslist posts and didn't really get any responses. And I finally just begged my little sister, who was like 16 at the time, to come with me. And so we just, were sprinting around all day. But there was definitely a moment during all of that where I think I was like, what on earth have I done? Like, this is such a mistake. Like, just dreading pulling up and into, my car to actually get things underway and so on. And, it ended up going really, really well. And I actually think that was one of the better events that I did in terms of what came out of it. Had a really good relationship with that studio afterwards. I'm guessing because things went so wrong and I was able to kind of correct course and it gave them a lot of confidence. But that entire week was just like, oh my gosh, I'm in way over my head. Never want to feel those emotions again.
Hmm. With the benefit of kind of hindsight, looking back at, would you say you've got any regrets about the entire process, or like what are some lessons you've kind of reflected on and learned you've picked up on where you now like kind of impart onto the founders that you talk to at Techstars or some of the other places you've mentored founders in?
Yeah, I mean, I think that one of my biggest regrets is not holding on to it longer. I think that I had gotten to a point where I was just a little bit fed up with having to run things on a day to day basis, and frankly, I probably did not have the skills to do it effectively. And so somebody gave me an unsolicited buyout offer, and I really jumped at it. And I think I was building something that really had some longer term some longer term opportunities. So I think selling too quickly was probably one of my big things, which is like, yeah, I sold it after maybe 15 months, 18 months, something like that. And yeah, I mean, like I said, it was great at the time from like a financial perspective, but it would have been cool to see where that went, because I think that I could have run that for several years longer and really enjoyed doing it.
Hmm. Well, you in college, a big part of the audience that I want to cultivate for this particular podcast is people who are in kind of my position where they've maybe been doing startups for a few years. They've got a little bit of experience. They're not total beginners, but they're not. They're also in the phase of life where they're still figuring out. They don't have the kind of crystal clarity. You mentioned college. Do you think now you're on the kind of investor and mentor side of things? Do you think it's important for founders to consider college? Like, if you know you want to build startups, do you think college is still something you should do and consider, or do you think it's worth just doing what you did, which is like start straight, go into building stuff and go into the real world?
That's such a loaded question to some degree, because I think that there's really great answers to either end of this. That college really might not make sense, and that college is really how a lot of things get done. And when you look at VC, I'd say that all in all, it tends to be a little bit more elitist. And so having a good college name on your resume can make life a little bit easier for you. At the same time, I'd say that VC is also very forgiving about resumes. If you actually look at private equity or investment banking, we tend to hold people to a little bit of a different background standard. Um, and because of that, I think, like I said, we're a little bit more forgiving. And so, in some senses, you're in the right industry for it. In others, you're really not. What I'd say is that if you're kind of thinking about going to college and thinking about not, I think the two things I'd focus most on are I would probably need to be really okay with the fact that I might not work for somebody, again, at least not for a very considerable period of time. And two, and I think this is probably the bigger thing I would tell people to focus on, is that not going to college, I think, has a lot of career risk in that if something goes wrong, you're not particularly marketable as an employee to a lot of different firms. And so I do think that there's a security element that I would almost say that if you're the kind of person that needs that, is really good to have. If you're not, then I think that there's really some optionality in terms of what you're doing. I'd also say that this, my background's been from more of a financial side of things. I'd say that because tech employers tend to care much, much more about, who you are, from a coding perspective. I think that that group probably needs to go to college, a bit less.
Mhm. You mentioned sometimes the VC world tends to have this elitist kind of view of things, and I've spoken to quite a bit of founders. I've also seen a lot of founders complain about fundraising on Twitter, and a lot of times they allude to the fact that they bootstrap not because they always want to, but because they have to. They have no other option because they can't raise. It seems like an impossible task, and I think it was Ben Chestnut who, they built MailChimp, and 17 years later they had a $12 billion exit. But initially, when asked about why did you just decide to self-fund it, he was like, well, we talked to every VC we could, and no one was willing to fund us. Do you see that changing to an extent in the VC world where this kind of new generation of fund managers and general partners, et cetera, they seem to be a little bit more less elitist, should I say? Maybe they're a little bit more willing to fund the underdogs, the people who are like, they've gone to maybe the crappy colleges or have no college at all, and they're kind of just like the underdogs of the underdogs. Or do you kind of see that still sticking around for the next few decades?
Yeah, I mean, as a VC, I think that college. I mean, if you're going to be a startup founder, I think the college argument's a little bit different, because as a VC, I think it's something that a lot will definitely care about to some degree, that you do or don't have that background. But I think all in all, when you actually look at it, I think that, like it's one of several aspects that I'm excited about a founder for. And so if they don't have that, and then haven't gone to a great school or graduated from a great MBA program, I can still build a thesis for the startup without question. I think it becomes a lot harder as an employee of a fund than anything else. But I would say that, I mean, I don't think so. I don't think that we're really kind of solving the, who's getting funding and who's not problem. But I think that speaks more to the fact that fundraising is a skill, and that it is something that is, at least in the early days, as important as your ability to sell to customers. I mean, if you really look at it, like a 1-to-1 capital efficiency ratio would be really, really, really incredible for a startup, meaning that I raised 4 million and now I have 4 million in revenue. Realistically speaking, it's probably somewhere closer to like 0.25. So I've raised 4 million and have something closer to 1 million in revenue. And so realistically, in your early days, you're getting more dollar or like higher dollar figures from investors than you are from your customers. And that takes a skill. It takes something that not everybody is actually equipped to do. And I think that the people who really are good at kind of getting the right advisors and things like that around them at an early stage to really prep them for that are the ones that end up doing best in those situations.
You mentioned that a lot of times when you're pitching VCs, a part of it is like you'll pitch like an associate or an analyst, and then they have to go pitch that to a counselor. They have to kind of sell that to the other people, or even if you're pitching a partner, there's always some kind of discussion. So they have to sell the other people that are not, that you don't see. And so you mentioned having advisors a part of doing that. So if you're like a founder who, say you don't have the fancy degrees, you don't have the JP Morgans or Googles on your kind of like resume, you're kind of the underdog, right? You don't have those fancy names. Those names don't pop out on your resume. How would you, maybe other than just building a great advisory team, and we'll get into building an advisory team as well, but what are some other ways you would try and sell VCs on the fact that you are the person to do this?
Yeah, I mean, I think that it's really just about understanding what a narrative looks like and what the investment thesis that the fund actually has and how they're actually going to look at the startup itself. It's a complex process, but I think that, like I said, I mean, with the right set of advisors, it can be a lot simpler because there are a lot of small tweaks that I think startup founders get wrong in the early days that are very clear. Like I think the one I hear most about is just kind of pipeline issues, right? We're speaking to people who primarily deploy capital at Series A and we're a seed startup. And it's like, well, okay, that's kind of the problem, right? You've taken 40 meetings with Series A investors in your seed stage company. Like that's where we're running into problems. And so there are a lot of kind of issues like that I think are pretty correctable pretty early on. Like a litany of different issues like that. And it makes it a lot simpler when you've got the right people around you to put that together. And I think for the people who don't or are having trouble with that, just start hitting people up, right? I think that one of the coolest parts about the startup ecosystem is how collaborative it is. That I can, get mentors. I mean, I've got several who get on calls with me regularly to kind of coach me on my career and have gotten nothing out of it and are very unlikely to get anything out of it. And I find that that's really par for the course in venture. And so just start reaching out to people. And if you're having trouble on that end, I really do think that an accelerator or something like that can be really beneficial.
Interesting. I want to get to the accelerator and mentors part, but let's kind of talk about. So I know we got deep into fundraising for a second there, but let's go back. So you sell the startup, you then join Brightlane. What was Why did you decide to kind of move into finance and venture capital from selling a startup? Because I was looking at kind of your history. And I thought, well, I would expect him to go build another startup or maybe be a builder, but you decided to go into VC. So why did you make that transition? And what was that transition like? What was it like going from being the builder to now the funder?
Yeah, I didn't actually end up going to venture capital right away. I mean, I certainly wish I had, but it's pretty difficult to jump from an undergrad to venture. I actually went to equity research after college, and I think for me, going to equity research was just the next step. I don't think that there was a lot of deliberateness behind it, other than I knew that I was going to start a company at some point, and I didn't really have something that I was particularly interested in at that time. But I'm not surprised that I took, I don't know, maybe 2.5 years to move from equity research to starting a startup, because it really wasn't the long term plan. I think I really wanted to be around people who were building companies, and I think equity research is just interesting because it can often feel a lot like value optimization rather than anything else versus value creation that we've got in venture. And I find that so much more interesting, even from a financing perspective. So I think that was it. I'm sure part of the investment research side too is that I ended up self-investing everything that I made in college, or excuse me, from the first acquisition and invested it while I was in college. And I think it just kind of followed in my head to some degree.
Tell me about that. Like you've now made a little bit of money, and you're starting to invest that in college. What were those investments? What was that like?
You know, I spent a lot of time day trading for a really long time, doing different algorithmic trading strategies at the time, more swing trading than anything else. But it was definitely a really interesting time because it was right when algorithmic trading was starting to really boom up. You had all these kind of small software platforms that were hugely expensive to actually write everything and so on and so forth. So it was an interesting time just because the landscape was really starting to shift a bit more. But I mean, it was fascinating, and I think it was really the first time that I got more of a crash course on what business actually looked like, and so on. So it was a good time. Yeah, I certainly enjoyed it.
Hmm. Yeah, I want to go back to what you said about accelerators. So I remember one of my first experiences with an accelerator was, I think I was like 14 or 15. I applied to a handful of them, Y Combinator and Techstars included, and surprise, surprise, I got declined and rejected from all of them. Partially because I probably didn't know how to pitch and how to structure, and yeah, I had this like really messy pitch deck. So now you're at Techstars, you're a VC there. What kind of piece of advice would you give to someone who wants to get in but has no idea how to, or has never applied to an accelerator, maybe doesn't even know what an accelerator is? How would you kind of approach the process of trying to get in, and kind of how to pitch yourself?
Yeah, I mean, I think so much about accelerators depends on the accelerator itself and where they sit. YC, I think, is probably a little bit more of a seed stage accelerator versus Techstars, which is a little bit more pre-seed. But I do find that it's really similar to raising traditional venture capital, with the exception of the fact that I think accelerators are a little bit more forgiving of it being a little bit more unrefined. And so I think that, there are a couple ways to really go about it, but you kind of need to approach it like you would anything in venture capital. I would say this: most accelerators, even the ones that appear to be generalist, are relatively thematic. And I think that it just makes networking in their spaces a little bit simpler. And I think that, like, when I'm looking at YC startups, for instance, if I'm talking to somebody who's going to apply to YC and I know YC doesn't have that theme and it really isn't looking to deploy to capital that space, I'm like, I would just don't worry about the application. Just save it for another time. This might not be the right time for it. So I'd say that that's probably one of the bigger things I'd pay attention to. But it really depends on the accelerator and where you're at. I think, though, for anything at that stage, I'd be selling myself more than I would my startup.
Hmm. So like, let's talk about Techstars specifically. What are the kind of themes of Techstars? And then like, how would you sell yourself to Techstars if you were trying to get in today?
Yeah, it's a great question. I mean, I think that the best way is certainly to have a lot of domain experience in whatever you're actually doing. I think that that's really the most valuable and really speaks to founders in a really cool way. But I think that there's a lot of things that you can leverage. I mean, anything that you have had from a professional success experience is certainly going to speak to your value as a founder. Like, we're looking for these people to be able to lead, $100 million plus enterprises in the next 6 to 10 years. We really do want them to be able to communicate a specific way and to be able to hold themselves a specific way and to be able to be successful at scale. So I think that all of that's really important. I'd probably say that for founders who don't have a lot to leverage on that side of things, the best thing that they can do is know their market through and through. I think it's interesting when you talk to a pre-seed or a startup versus a Series A, and you listen to them talk about their competition, and it's night and day. I think Series A, they tend to know these other organizations very holistically, where their kind of product features are centered and what they plan to be doing moving forward, and how valuable they are to X type of organization, versus at an earlier stage where I'm getting a slide about the difference in a handful of features or something like that, despite the fact that these are two companies operating in vastly different ways, or whatever the case is. So I do find that if you're trying to create more value in who you are as a founder, just really, really knowing everything about your industry can be really beneficial.
Hmm. I find that sometimes people in your position, they'll sometimes, because they get to interact with so many founders, they develop a degree of pattern recognition where they can recognize the winners from the people who kind of do okay, or sometimes don't even, kind of just like drop out. What do you think winners early on look different in terms of it, just personality wise, just, the founder themselves? do they look any different than the average? And what are some ways they are different? What are some ways the winners look different?
Yeah, I mean, I think winners are so frequently run by really charismatic people who can really get good people behind them. I think when I look at most of the winners I've seen in the past, most of them have had people at the helm who I would never bet against, even if I wasn't willing to bet on you. And I think that that's probably something that is really beneficial in building all of this. But I would say that, I've had plenty of situations where I have looked at a startup, thought nothing of it, there was nothing there, and then in a very short period of time they start doing well because I don't know, a handful of different factors change or anything like that. And so I'd also say that, like, to some degree, just give it time. The startup space is one that is constantly changing, and if you weighed who Slack was as a gaming company and held it against them, it'd be very hard to envision what they are today. And I think that that's startups are fluid.
If you can reveal, do you have any stories about kind of startups that you regret passing on and what happened to them afterwards and how they hit that growth curve?
I always hate this question. Yeah, no, I've got one really good one on my what it's called, the anti portfolio, stores I didn't invest in. I met Whatnot at pre-seed. Whatnot is a collectibles platform. I think their last valuation was something like 4 billion, and it was the largest e-commerce marketplace, or the quickest e-commerce marketplace to reach 1 billion in valuation. Happened kind of seemingly overnight, and so within 2-3 years of us meeting them, they were absolutely crushing it. And going back to what I was saying, I think part of it is that they were a different person when we first met them. I think the startup itself was much less focused, or not focused at all, on live shopping, which kind of became the central theme of who they were, and things along those lines. But man, there were certainly some things that we probably diligenced incorrectly that we needed to have looked at a little bit different. But yeah, no, it was certainly an interesting time, and we had a lot of very long and heartfelt conversations at Brightline about where our investment thesis might have fallen short, and what to do about it moving forward, and so on and so forth. And I think especially because I was new to venture at the time, it was not the most fun.
Interesting. So you missed out on a $4 billion investment. Looking back to the extent that you can reveal, you mentioned you reflected on that quite a bit. What would you have done differently about the research and due diligence process?
Yeah, I mean, I think that I think so. I mean, for reference, we spoke about this and we're working on this longer than I think I ever have in the past. And I think that like with any deal I've ever had, like we've never just kept coming back to different questions, and we were just so bipolar in terms of liking it in some ways and just hating it in others, and it was just a mess. And so I think that part of it is that I would have done a better job of kind of keeping us on our typical diligence track, because I think that we weren't helping ourselves by just continuing to review and review and review. I think that it really got in the way. I think we also just really failed to give credence on the level we should have to some of the things that were going right. I think one of the things that was just incredibly impressive at the time that we really discounted was their acquisition rate. Their acquisition rate was under $1. I mean, they were getting customers for nothing. And I remember just kind of breezing over that in a lot of conversations that hey, this was a consumer startup that isn't really paying for anything. I think we also probably held a lot of things that startup their age should not have had figured out against them in kind of a tough way as well. But I do think that like overthinking things was probably one of the bigger things, where we just got way out of our normal diligence process and weighed in way too much. But I think we also really just kind of struggled with the fact that we missed some kind of key areas like acquisition.
Hmm. Out of curiosity, if you can reveal, how did they have a customer acquisition cost of under $1? That's really surprising for a consumer startup.
Yeah, I think that it was really a cool experience of really just having a startup in a nascent space. And when you really look at a lot of what we invested in at Brightlane, the things that have done well have been the ones that are at burgeoning markets at really kind of critical points. And when you look at Whatnot and look at even what's on the market today, I mean, they've definitely had a couple people come and be competitors to them, but it has never really been what it has there. And so I think it's this interesting mix of, new in the collectible space. And I also think, really just kind of in a really interesting timing where things like live shopping, and other trends really hadn't taken off in the United States just yet, like they had overseas.
Hmm. Interesting. So it's kind of like the saying, the riches are in the niches. The fact that they exist in such a up and coming niche market gave them the ability to acquire customers for such a low price.
I wouldn't say that you need to be in a completely nascent space to build something. I think it's really rare that startup founders are, and I will say that I always pay a lot more attention to deals in one where there's truly nothing in or around this, because I think that more often than not, those are the ones that tend to do really well, from a top end perspective.
Mhm. Well, we talked about the loss. I want to give exposures to maybe some what you would say some of your most successful investments have been to end this interview off.
Yeah, I think our most successful investment to date has been PrizePicks. PrizePicks is in the daily fantasy sports space, and they were a really interesting platform. When we first met with Alex, and we're learning a little bit more about what he was up to, he had a ton of experience in sports gambling in the past. It was unbelievable how well he knew the space, and he had this very interesting go to market strategy in states that the kind of more legacy players at the time just weren't paying attention to. They were focused on markets that had legalized sports gambling, and really going after those versus kind of laying the groundwork in other states. And so he's done just a remarkable job on that end. They've grown to very significant size at this point. I don't know if I can reveal much, in terms of where they're actually at, other than I think that they just hired their 600 or 700 employee, and are growing at just an incredible rate. So they've been a big one. And I think, another would probably be Avail Finance. I think that was one we talked about a little bit as well. Avail Finance was actually in India, really fascinating platform where, the blue collar side of the financial space in India is more or less non-existent. There's not a lot of financial products for them. There's not a lot of banking opportunities, and so forth. And so it's a really interesting time as their middle class and lower class are being brought up by economic circumstances, just being there with a financial product in an early stage. So I think those have been the two most successful to date, but certainly still have plenty of them out there, right?
Yeah, absolutely. You mentioned that there were a couple things that stood about the founder of Price Picks. The fact that he had a lot of experience, he had this interesting go to market strategy. What are some other things, maybe just about whether it be his character, his mindset, just things like that that stood out to you during that meeting where you were like, oh, this guy, he's got something special, other than just like the obvious things like his experience, etc.
Yeah, I mean, I think the thing that comes with really great experience, and really having a deep understanding of different areas is just that you have more confidence. And I think when you go into those meetings, and you speak to me like an executive, I mean, we all listen to executives talk. I think it's interesting that more startup founders don't try to replicate that, which is this very certainty driven response to what's happening, and what's going on. They ask and answer very direct questions, and they don't really shy away from things. And I think that he's one of, several founders like that I've met, who you listen to them talk a little bit, and it's amazing how much you can forgive about a startup in their circumstances, in those situations. I mean, we invested in Adam in April of 2020. So COVID had just shut everything down. They went from whatever revenue they had to zero overnight, and needed a bridge round just to kind of get them through. And there was obviously large competitors in the space. I mean, there was hundreds of reasons to say no to this, and one exceptional one to say yes, which is you're talking with a founder who sounds like he's exactly where he belongs. And so I think that confidence is something that most startup founders, don't end up speaking to VCs with quite in the same way.
Oh, interesting. So it's kind of like observe what a executive sounds like when they're on like CNBC or Bloomberg. Kind of observe their mannerisms and almost try and replicate that confidence and what they have there, so that you sound like that. Is that kind of what I'm getting right?
Yeah, I mean, I think that for startup founders, and I was actually just telling somebody this on Friday, I think in a lot of situations, they just get so beat up because being a startup founder is hard, and there's always a new issue. And so I get people who come in front of me and who have great traction and are doing really cool things and are coming to me and they sound beat up. They sound like things have gone poorly or haven't gone perfectly or whatever. You just kind of hear that. Versus those who have gone through those and recognize the fact that they've gone through those and things are still going well. I think that they use that as a source of confidence and not as the opposite. And I think that good founders and the difference between good and great founders, I think, is really almost that piece, which is like, can you really look at what you're doing and be excited about it still, even after everything's gone wrong? And I think that the people who really know what they're trying to build are much more excited about that. And it tends to show.
Hmm. Interesting. I want to point out a lesson there because I think with a lot of people, like, there's been Theranos and a bunch of other startups that have imploded because they had charismatic founders and they were super confident, but they oversold what they could do. And they, in some cases, unfortunately, defrauded investors. But that's kind of made a lot of good builders kind of hesitant about kind of selling the big dream, and they've become a little bit more fearful about trying to sell that big vision and that the ambitious side of things. If you were a founder, like I've spoken to quite a few that are a little fearful of being that way because they feel like, excuse my French, but they feel like they're bullshitting investors to an extent, with just how confident they are and how certain they feel. They sometimes make the mistake of conveying the uncertainty they feel. But like you said, a lot of times the job of an executive is to make sure the others don't see how uncertain they are. So what would you say to a founder that's in that position?
Yeah, I have no problem with founders who have grand visions and are very excited about their grand vision. I actually think it's really admirable and something I'm very excited about. But I would say that what happens in a lot of situations is that they tend to be naive to a lot of the risks or assumptions that they're taking. And I find that the more they understand the risk of what they're taking, the better they're going to do. And so if you are somebody who's done well with that strategy, I would certainly keep doing it. Just know that this is an inherently risky investment still, and that you have, you know, risks that are idiosyncratic and that are specific to you, and what you're trying to do, and know that VCs are going to poke into those, and that's fine. I even tell founders, if they poke too many times with it, just say, hey, it's a risk. It's something you're going to need to feel comfortable with if you're going to make an investment. But I think that having the kind of head in the clouds, it has to be paired with that. Otherwise, I'm just concerned that the founder doesn't really know what they're doing at that point. So I think that you probably kind of want a mix of understanding those two areas. But I think that coming in with a grand vision is extremely valuable and something that you should have a lot of conversations with. But I think that, you also need to remember that you're fundraising at a stage, and that stage has benchmarks, that those benchmarks are really more what you're going to be graded against, than the longer term vision, unless you're like a pre-seed founder or something like that.
Absolutely.